Good morning, everyone. Hi, I'm Scott Clavenna. I'm the CEO of Green Tech Media, and I'm delighted to be here again now for our 5th U.S. Solar Market Insight Conference. Quick show of hands, how many of you have been to one of our Solar Market Insight conferences before? Good, good. A lot of alumni. Well, for those of you that haven't been here before, just a quick overview about Green Tech Media and about what we do and about this conference. I mean, the interesting thing for me about Green Tech Media is that we've been able to bring together under one roof a really world-class market research division company, and then pair that with our news site that is the leading news site in this industry, and then bring that audience and the analysis that our GTM research division puts together here live at these conferences. And so I think for those of you that haven't been here before, what you'll see that I think we do quite well is actually make these conferences ones that you want to be in here for, not just out in the hallways talking to your colleagues and making new acquaintances. In here, we really are bringing together not just industry leaders to talk about the big issues facing the solar industry, but we also have our analyst and editorial team up on stage, bringing their analysis, their data, their perspectives to the conversation, and some really world-class thinking to you while you're here in the room. So I hope you have a great experience. You can ask a lot of tough questions. These are definitely really smart folks we've got moderating these panels and driving the dialogue here, so definitely take advantage of that while you've got them. A few notes to get started. First, I want to thank our sponsors. They've been with us for many years, and we've got some new ones and then some returning ones as well, as usual. And again, they help us put this on. You'll see some of them up here on the stage at various panel sessions. You can also see some in the tabletops, and we also have a few sponsoring the lunches and reception too. So thanks again to the sponsors, and a big thanks to SEIA, the Solar Energy Industries Association, which has been a partner with us in this conference series from the beginning, and it's derived from the partnership that we have around the quarterly research service that we have, U.S. Solar Market Insight. So that's where we get the name, and that's a quarterly market research service that tracks the U.S. solar market state by state, sector by sector. So a few things I just want to make you aware of while I have your attention before Shayle comes on. Lots going on here next year at Green Tech Media. One of the ones that we're excited about is we're finally taking our solar conferences international. So our first international conference will be January 27th and 28th in Mexico City, the Solar Summit Mexico. So we've been doing quite a lot of research on the Latin America solar market, and I think we have enough understanding and developed enough insight to now take our brand of conference to Latin America. So our first stop is in Mexico City in January. So I definitely encourage you to check that out. And if you have any business or if you're thinking about entering the Latin America market or specifically Mexico, this is going to be a great place to dive right into that ecosystem. Another thing that's fairly new that I wanted to bring to your attention, if you are Green Tech Media readers, which I hope you are, one of the things that we've launched in the last month is GTM Squared. And so that's a premium membership to our news site. So beyond the daily news that you see each day, now we've got a premium bundle of content that's on the site as well. And that includes in-depth feature stories, analysis, so not just things out of the headlines or out of the current events, but more technical deep dives on subjects, or more specific looks at regulatory proceedings. All throughout the market now, we're going to have a set of premium content on the site. And in addition to that, there's an interchange podcast between our editor, Stephen Lacey, and our Senior Vice President of Research, Shayle, Kann, looking at real deep discussions on events shaping the landscape here, as well as discounts to conferences. It's a really great value at $200 a year. So I encourage you to check that out. I think you get a lot of value out of becoming a member. A few housekeeping notes before I hand it off to Shayle. There's the Wi-Fi network. There's a specific one here for the show. The network is Citon. The password is USSMI under 2015, and that is sponsored by Citon. The SMI event website has restaurant options for on and off property for your stay here. Lunch is going to be served in the Bay Terrace, and that's sponsored by Jinko. There is some chance it's going to be raining, so we'll let you know for sure. The Bay Terrace is outside, right off the registration area. If it is raining, then that may come inside. So we'll make an announcement before lunch around that. Same goes for the networking reception tonight, 5:45 to 7:30. That's in the Bay Terrace as well, sponsored by DuPont. Again, we'll have a note if it's a little too crummy and we have to bring it inside, but hoping for good weather. Tomorrow, breakfast begins at 7:30 in the Commodore foyer with the general session starting at 8:30. So note that your agenda booklet say the agenda starts at 9, but we've pulled it back to 8:30 because Ron Resch of SIA is going to have a conversation, a remote conversation with us, with Shayle up here on stage to talk about his perspective on developments in the U.S. solar market. All right. So with that, again, one more note of housekeeping, actually. Shayle is going to present here on the next order of solar magnitude. His presentation, along with any other presentation you see over the next 2 days, will be available to you, so you don't have to take a ton of notes if you don't want to. What's going to happen at the end of the show, an email will go out to all the registrants, and all you have to do is fill out a quick survey about the show, and then you'll be able to download all the presentations from the entire conference. So with that, I'm going to hand it over to Shayle Kann. He's our Senior Vice President at GTM Research to talk about the next order of solar magnitude. Shayle?
Thanks. Great. Thank you, Scott, and thank you all for being here this morning. So we're at a really interesting and exciting time for solar in the U.S. If you look back just 5 years ago, if this were the end of 2010, we'd be congratulating ourselves on just having hit the 2 gigawatt cumulative mark for PV in the U.S. That was at the end of 2010. That year, the U.S. installed about 800 megawatts, a little over 800 megawatts. So it had nearly doubled in 2010 alone. Now, here we are in 2015, and we're going to install over 7 gigawatts this year alone, and at the end of the year, we'll hit something like 26 gigawatts of solar cumulatively. So the solar market in the U.S. has increased by a full order of magnitude over the course of 5 years, which is impressive. And there are a bunch of ways to look at what's going on right now in the market and where we are as a market. But there are a couple of milestones that I think are exemplary that we are about to hit or are hitting right now. The first is that sometime early next year, likely around February, it could be January, depending on how fast the market grows, we will have our millionth solar installation in the U.S. So there will be 1 million operating solar projects generating power every day as of sometime early next year. And second, sometime even sooner, potentially end of this year, depending, we're going to hit the point where solar is consistently generating 1% of all the electricity in the U.S. It's already up over 1% of capacity. It's more like 1.6, 1.7% of all capacity in the U.S., and we are, depending on the day, getting very close to it being 1% of generation. So we've come a long way to get to that 1%, but it's important to remember that we are still at 1%. Another milestone that I think is interesting and important, if you think back to 2012, you remember the DOE launched its Sunshot Initiative in 2012. And the Sunshot Initiative had a stated goal at the time of getting costs down to the equivalent of about $1 a watt for utility scale fixed tilt system in the Southwest. That was supposed to equate to about 6 cents per kilowatt hour on a levelized basis, which the DOE reckoned more or less would make solar economically competitive without subsidies. And the reality is we're probably going to hit it. We're going to get very close. We're doing a lot of modeling, bottoms up, of turnkey systems for utility scale. And, you know, even today, this 145 a watt for 2015, that's high for some systems. And in fact, we've been hearing systems quoted for 2016, particularly in the Southeast, that are already approaching $1 a watt. So even on an average basis, by the end of the decade, we should be getting very close to hitting the DOE's target, which, when it was launched, was quite ambitious. You know, there was no guarantee that we were going to get to $1 a watt by 2020, or $1.50 for commercial, or $2 for residential. But we're doing that. So from my perspective, what that means, what all these milestones mean, apart from just being symbolic and interesting, is that I think we're past the point of proving out solar as a technology that has a meaningful role to play in the electricity mix in the U.S. It does. And solar will be an increasing share of electricity generation in the U.S. It will play an increasing role over a long period of time and not just a short period of time. There was a period when I think you could make a pretty cogent and well-supported argument that solar was going to be a temporary phenomenon in the US that was driven by incentives, and perhaps a polysilicon glut drove prices down, and maybe that wouldn't last. I think we're past that now. And part of what that means, ultimately, is that the solar industry should be thinking in slightly longer terms than it's used to. I think we spend a lot of time, particularly in the US solar market, thinking about the next quarter or the next year or the next incentive reduction. And indeed, we need to do that, right? Everybody has to keep the lights on and keep growing. But I think that it is time to start thinking about the next order of magnitude. If we grew by an order of magnitude from 2010 to 2015, what will it take to grow by another order of magnitude to start having a real meaningful impact on electricity in the US? So what is the next order of magnitude? Well, if we're at 1% of total national generation today, what is it going to take to get to 10%? Roughly speaking, if we were at 2 gigawatts in 2010, we're at 26 gigawatts or so at the end of this year. We need to get to 250 gigawatts of solar, more or less, in the US in order to hit 10% of national generation. How long will it take us to get there? Well, obviously, that depends on how fast you think the market's going to grow. If the market, beginning next year, averages about 15 gigawatts a year, then we're going to hit that in 2030. If the market averages about 22 gigawatts a year, then we'll hit it in 2025. I think that that's about the right range to think about in terms of realistic market growth. I mean, those are both big numbers. For context, 7.5 or 6 gigawatts this year, maybe 12 to 13 gigawatts next year, and we have to average somewhere between 15 and 22 gigawatts for the next 10 to 15 years, even with an ITC expiration in the middle of that. So that's meaningful growth. But I think it's about the right way to be thinking about this, which is to say that we should be trying to aim toward hitting the next order of magnitude for solar in the US over the next 10 to 15 years. That's a lot of solar. And it also carries with it, I think, a bunch of considerations that you wouldn't necessarily be thinking about if you're just thinking about the next year or the next 2 years or even the next 5 years. So what I wanted to talk about this morning is some of the factors that I think are going to help solar hit that next order of magnitude. What are the catalysts for growth? And then on the other side of the coin, what are the potential barriers that we're facing, both in the near term and then as we actually do start to grow up that penetration curve in a significant fashion, what are the things that will pop up that can act as bottlenecks? And then finally, what are the things the solar industry should be focusing on right now if we're taking a longer term view and trying to get to that point? So let's start with the good news, which is the tailwinds. What's going to help solar get to that point? And we could start with pretty much the fundamental premise of solar economics in the US, which is that electricity prices tend to rise, right? Solar is generally, especially in the distributed solar market and to a sort of different extent in centralized solar as well, it's compared against the cost of electricity. And the cost of electricity historically has risen at faster than the rate of inflation in the US, and by most accounts, it probably should continue to do so for the next few decades. The EIA is forecasting that electricity prices should grow by something like 2.6% annually through 2040. And even when you account for inflation, say 2% inflation, it's about 0.6% annual growth on a real basis. In other words, electricity prices will continue to rise, which will just make solar look more and more attractive in comparison. Of course, the other side of that equation is the cost of solar, and the cost of solar, fortunately, should keep falling for that same period of time. At the residential level, we're modeling out, and I should note we have very conservative modeling for long-term cost forecasts based largely on known incremental cost reduction opportunities plus some learning curves from other construction-based industries. So in fact, the market could beat this. But even with a pretty conservative methodology, if you're installing for $350 a watt on average, all in for residential solar today, lower if you're a leading manufacturer or a leading developer or installer, but $350 or so on average, we should be down beneath $250 by the end of the decade, beneath $150 by the end of the next decade. So solar costs keep falling, electricity prices keep rising, and solar keeps looking more and more competitive. And this is true at the utility scale as well, though there's less you can eke out of a system cost at utility scale at this point. So where we'll be approaching $1 a watt by the end of this decade, we should be below it, though incrementally below it, by the end of the next decade. And again, it's possible we could beat these numbers, and certainly best-in-class systems probably will. But the broad trend here remains the same. Electricity prices go up, solar costs go down, solar looks better and better. That's the pure economic factor. Then there are some other catalysts that can help the solar industry grow even more that lie apart from this. One good example of that is a clean power plan. So the clean power plan, we're in an interesting spot with it right now. The final rule has been announced by the EPA, but the states are the ones ultimately have to craft their own implementation plans. And the states have actually a lot of leeway in determining how they're going to implement the clean power plan, which means that until the states submit their implementation plans, we don't know exactly what impact it's going to have on the solar market in any given state. We can pretty safely assume the Clean Power Plan will only have a positive impact on solar, not a negative one, but we don't know to what degree and exactly how. That said, you can look at the rule for the Clean Power Plan and figure out a bunch of ways in which it could have a pretty meaningful positive impact. And one of the ones that I think is particularly interesting is in looking at the comparison from a geographic standpoint of where the Clean Power Plan sets stringent greenhouse gas emissions reduction targets and where the solar market exists today. If you look at the 10 states that have the highest greenhouse gas reduction targets under the Clean Power Plan, the most stringent targets, basically none of them, with the exception of Colorado, has any kind of a meaningful solar market today. These 10 states together account for 1.4% of all the solar capacity in the US. In other words, the states that are going to have to make the most drastic changes are the states that don't have a solar market today. And this is true to some extent in the Southeast as well, and some other states that are not traditionally big solar markets. That's pretty exciting over the long term, because if we're honest with ourselves, the solar market in the US is still way too geographically concentrated in a very small number of states. In the residential sector, California still accounts for 50% of the overall national market on its own. The top 10 states overall regularly account for over 90% of all the installations that take place in the US. We are still dependent on a small number of states, and that works for growth to date. Certainly none of those states, with the possible exception of Hawaii, are approaching a point of penetration that you're not going to exceed. But it doesn't work to get to 250 gigawatts if you're going to rely just on those 5 or 10 states that are big markets today. So one of the exciting things about the Clean Power Plan is its potential to open up new state markets that basically don't have any solar today. I should note that there is a downside to the Clean Power Plan that I don't think gets enough coverage, but actually does matter for the solar industry in the US, and it has to do with timing. The Clean Power Plan first target, the first compliance date is 2022. They, in the final rule, added something called the Clean Energy Incentive Program, which is basically an added incentive for states to put solar and wind online earlier, specifically in 2020 and 2021. So states effectively get double credit for any solar that comes online in those years. That's great, but they don't get any credit for solar and wind that comes online before 2020. So if they're operating purely based on how to maximize the Clean Power Plan, states will design implementation plans that basically don't incentivize any solar until 2020. And then they'll incentivize a lot of solar. And that's weird timing for us, right? Because we have the potential ITC expiration, and 2017 to 2019 is going to be a really crucial period to maintain some kind of growth in the absence of a 30% ITC. It could be the same time period during which states are basically pushing utilities to push out the solar market. So that's a downside in the short term. In the long term, though, there's no question the Clean Power Plan will have a great impact on solar, particularly over the next decade from 2020 to 2030. And then one final positive factor that I think is interesting and nascent today that could impact solar's growth over the next decade is market reinvention. The electricity market, especially in a few key states, New York is the easiest one to talk about, but California has this going on. There's, to a lesser extent, places like Hawaii and Minnesota and Texas. They all have regulatory proceedings right now that are surrounding reinvention of the electricity market at the edge of the grid, where the utility meets the customer. And largely what these proceedings are trying to do is figure out ways to make distributed energy resources, which includes solar, fully valued and monetized within the electricity market so that it can be sited where it's the most valuable, so that it can get value out of that and provide services to the grid. And so, you have a bunch of things that have happened individually. A few examples of them in California, the Cal ISO introduced something that basically is a way to let distributed resources get aggregated and bid into ISO markets. It introduced my favorite acronym in the industry right now, which is DERP, Distributed Energy Resource Provider. In Texas, in ERCOT, they set up the DREAM task force. DREAM is Distributed Resource Energy and Ancillaries Market Task Force. We're really stretching on acronyms now. It's getting harder and harder. So ERCOT has this task force that's trying to figure out exactly what level of DER participation they want in ERCOT markets. In New York, there's a ton going on because of the REV initiative, Reforming the Energy Vision. But there's also demand response programs at the ISO level. And these are just a few examples in my mind. California, you could point to, there's DRAM, the demand response auction mechanism is another one that's interesting. The point to me about this is that I think that we've grown very accustomed to a single source of value for distributed solar in the US, which is bill reduction for a customer, right? Every distributed solar project right now is basically receiving that single value. And the promise of the future is that solar, especially when paired with other technologies, load control, energy storage, things like that, may ultimately be able to receive an additional value stream that comes from providing some value to the grid or to the ISO. So if you sort of stack all of that up, you've got solar costs coming down, electricity prices rising, the potential for new revenue streams for solar that go above and beyond the traditional bill reduction for distributed solar. And you've got the Clean Power Plan that's going to pop up and probably create some new incentive programs for solar. This is all positive, and it's what makes me so confident that it's possible to get to the next order of magnitude. But let's talk about the other side of the equation, because I think there are some things that are real barriers that have to be reckoned with, either in the very short term or over a slightly longer period of time as we're figuring out how to get to that next order of magnitude. The first one is the most obvious and the most near term, which is ITC expiration. So we're now a little under 14 months away from the scheduled expiration of the investment tax credit. And the reality is nobody knows what it's going to do to the market. We spend so much time forecasting this and running project models and trying to figure out exactly how it's going to impact the market. Nobody truly knows. Some people will tell you they think they're going to be fine. Some people will tell you the world is going to fall apart. The reality is we know this. The economics in 2017, unless everything goes right, are going to be worse than they are in 2016, which is something that we basically haven't seen in the solar industry in the US in 15, 20 years. And the result of that is likely to be the first down year for solar that we've seen in the last 15 to 20 years in the US. It may not be the end of the market, and growth may continue thereafter, but a down year is something we're very much not accustomed to. And it's going to be particularly painful in states and markets and utility areas that are sort of on the margin of profitability, right? You lose a lot of those. So even if California's market remains relatively strong, maybe you don't have much going on in Ohio where it was just starting to open up. So ITC expiration clearly in the short term is a potential barrier to this growth. But we're thinking a bit longer term now, and I think we can all probably agree that over the long term, if we're talking in a 10 to 15 year time range, that solar still has the potential to grow and still has the potential to reach the next order of magnitude. So let's look at some of the factors that might come into play over a longer period of time. You can't talk about the potential barriers to solar, particularly distributed solar and particularly residential solar, without talking about reform to rate structures and reform to net energy metering. We've been sort of covering this and paying attention to it for years now. And largely speaking, the solar industry has come out mostly unscathed thus far in the many, many regulatory venues where there has been some proposed reform to rates or net energy metering. But I don't think, first of all, that means that's always going to be true. And second, we are starting to see now the first real meaningful reforms to both rates and net energy metering in states that have big solar markets. And we can give some examples of that. So we've been spending the past year or so trying to build out these models to be able to accurately assess exactly what impact various reforms to rates and reforms to NEM will have on the economics of residential solar. And it, in some ways, is, it makes you think that residential solar is relatively stable and not going to disappear unless something drastic happens. And in some other cases, it makes you think, boy, we are really dependent on today's rate structures and today's net energy metering. So as an example, if you model out projects, and we're looking at a project that has a real customer load profile, real electricity rate structure in the largest utility territory in each state. And we modeled out for 50 states, and we're basically trying to say, given a 20-year customer contract, can you offer a customer year one net savings? Which is sort of the equivalent of saying, are you at grid parity? And this is including all state-level incentives, all federal incentives. Right now, there are about 20 states, given all the incentives that are available and the economics of solar in those specific states, that are more or less at parity. And of those states, about 15 of them are at what we would call the tipping point to open up a market, which is to say, can you offer a customer a 20-year contract, whether it's a lease or a PPA or the equivalent of a loan, that has 10% savings, net savings, on day one. That's more or less the time at which the market starts to turn on, and there are about 15 states where that's true, and that's borne out in the market today because there are 15 states where there's any kind of meaningful solar activity at the residential level. So that's today's value proposition. Now, what happens if you change the economics by changing net energy metering? So you could take a bunch of different examples here, right? Fixed charges was probably the first big thing that we started to see get proposed a lot by utilities. Hasn't been all that successful for the utilities, mostly not getting a ton of fixed charge increases. But another that is starting to happen now, and Hawaii is the first example of this, is changing the net metering rules so that the export, when you generate power that's fed back into the grid, is compensated at something less than the retail price. Right? And in Hawaii, it ends up being about half of the retail price, closer to the wholesale or the generation price. So what does that do to the economics in all these places? Imagine if in all of those states, and we'll just look at the top 20 that are basically at parity today, here's where you are today. What happens if you take all those states and then you change the export rate to make it about 50% of retail? So again, this is basically what's been implemented already in Hawaii under the grid supply tariff. It's also more or less in line with what the IOUs proposed in California in the NEM 2.0 proceeding. So if the utilities were to get more or less exactly what they're asking for, what does that do to the economics? Well, it basically takes every single state out of parity. Hawaii's close, and I think in reality, the Hawaiian market is not going to disappear tomorrow as a result of this. But it's hard to make the economics pencil today anywhere else if you all of a sudden change it. In reality, it won't go quite this drastically, right? You probably end up in California when we get the next NEM. It's probably going to be somewhere in between, or it may have some different components to it. But the point that I'm trying to make is that residential solar is still highly dependent on rate structures in NEM. Another real-world example of this that is playing out right now is in Salt River Project territory, SRP in Arizona, which introduced a higher fixed charge and a demand charge, one of the first residential demand charges in the country, something else that I think is going to start to become more popular. And SRP was running at about a pretty consistent 10 to 12 megawatt per quarter clip for residential solar, right up until those charges started to take hold and we got through the backlog of projects that were already qualified, which is the third quarter of this year, at which point we got 3 megawatts of residential solar installations, about a 75% decline quarter over quarter. So these things do matter, and over time can still erode the economics of residential solar. And then finally, there's something that I don't think is talked about enough in the industry, but is pretty well understood particularly in academic circles, and that's the value deflation effect of solar at higher penetration. Basically, it's a pretty simple concept. As solar penetration grows, the next kilowatt hour of solar that you put on the grid becomes less than the one before it, because solar is non-dispatchable. It generates when it generates. And so you can look at this from two perspectives. One is wholesale pricing, right? The more solar you have online, the next one bids in at zero because there's no marginal cost of production for solar, and ultimately bids down prices over time. The more you put online, the more it bids down prices and the less value you can get for the next one. The other way to look at this is value to the grid. When you have more solar penetration, you don't need as much generation at the times when solar is generating, right? In the middle of the day. It's great for a while, but then you get to the point where the times when the grid needs more generation is in the evening ramp when the sun sets, and then in the evening peak when solar is no longer generating. And there have been a lot of studies that have measured this and tried to figure out exactly how big this impact is, but it's meaningful. This is just looking at some data from a Lawrence Berkeley National Lab study that was modeling out basically a grid that's supposed to look like California, and then taking solar at various levels of penetration and looking at the marginal value that it provides to the grid. It starts out more valuable than a flat power block. In other words, the first bunch of kilowatt hours of solar, megawatt hours that are generating are more valuable than just something that is generating a fixed amount all the time. It starts out really high. But very quickly, as you get to higher levels of penetration, it falls below the flat power block and then continues to fall. And you get to this point where, relative to zero penetration, the value of solar is down something like 40% to 10% penetration, and as much as 72% at 30% penetration. So as solar's penetration grows, it's going to become less valuable to the grid. There's basically no way to avoid that. Now, you might look at these numbers, and particularly in California here, and say, well, look, I mean, it starts at $90 a megawatt hour. That's high right now, especially for utility scale solar. And even at the end there, it ends at $25 per megawatt hour. You know, we could maybe make a 2.5 cent PPA work that far into the future. And that could be true, but this is California where prices are higher. Imagine if you saw this in a state where prices start at 5 cents as opposed to 9 cents. Which is all to say that grid parity for solar is a moving target, and it may not move in the direction you want it to move over time. I think there's a tendency to say, like, we're going to hit this point, we're going to get to grid parity, and then everything is solved. We're at parity. The reality is, as solar continues to grow, that number that you have to hit to be at grid parity may actually shrink. We're not very exposed to this today because, first, you know, projects largely have long-term contracted cash flows. Utility scale projects have a 20-year PPA. They're not subject to marginal prices in the wholesale markets. Residential, commercial projects, they benefit from net energy metering. And second, we're just not at that high a penetration in most of the country. But I think it's reasonable to assume, or it's at least prudent to assume, that solar is going to become more exposed to this as time goes on, because as the value decreases, the markets are going to react. Again, this just means you need to keep your foot on the accelerator of cost reduction, because because you get there at one point doesn't mean you're there tomorrow. So we have factors that are pushing in both directions, right? We have sort of some fundamental economic factors that are going to make solar more and more attractive, along with public policy and some market reinvention that could open up new revenue streams. On the other side, we have revisions to rates that could impact distributed solar. We have this value deflation effect as we get to higher penetrations where it's going to get harder to make the economics pencil. What can the solar industry be doing in the meantime to make sure that growth is consistent and continual and that we get to that next order of magnitude sooner? Many things, but a few. So the first is that, if you look at the cost of solar in the US today, especially residential solar, here's a breakdown of an average residential system broken down into its composite parts. So this is that 350 a watt system that I showed before. There are some pieces of this that are sort of ridiculous. The soft costs in particular are completely crazy for solar in the US. We're still at over $2 a watt on average of soft costs for residential solar, and particularly customer acquisition costs, which on average are maybe 43 cents a watt. But actually, if you look at SolarCity's earnings, I think last week, they're at something like 60 cents a watt and flat. It's not falling. I mean, that's a crazy high customer acquisition cost. The customer acquisition cost for competitive retail electricity is the equivalent of 2 or 3 cents a watt. It's nothing compared to this, right? So the first thing we can do is figure out radical ways to get soft costs down. I don't have a solution here, but this is clearly still an area where there is headroom in costs that is not being accounted for when we're doing our forecasting. Because right now, I don't see a way to get those customer acquisition costs down from 40 cents to 10 cents. And then even on the hardware side too, right? Today's hardware costs, which are, for residential solar, maybe $1.20 or $1.30 a watt, something like that. That's higher than the overall system price needs to be when we're thinking a little further down the line. I mean, we have to reduce hardware costs as well, and it can come from every individual component. Maybe we should be thinking a little further outside the box. Maybe we should be thinking about fully integrated modular plug-and-play systems. Or maybe we should be re-examining the possibility of BIPV, which building integrated PV was hot back when thin film was hot, in 2008 to 2010, and then it's sort of fallen by the wayside. I think it's worth consideration, at least if we're thinking over the long term again. So think about long-term costs and figure out ways to get step function reductions rather than just incremental reductions. Beyond that, though, value deflation, is an issue that solar faces in a vacuum. If you just put more solar on the grid, then it's going to become less valuable over time. This is part of why so much of the solar industry is and should be so excited about the long-term prospects for energy storage. And I can give you a very real-world example of the impact that that has. So we're going to look at a typical day's generation in Kauai, the island of Kauai in Hawaii, which is run by the Kauai Island Utility Cooperative. So on any given day, and this is an actual day, this is October 14th of this year, this is how the generation mix looks over the course of the day. It starts out with there's basically one baseload gas plant that's operating pretty much all day, and then a bunch of smaller diesel plants. As we know, Hawaii is an island, it has expensive electricity and a lot of diesel. And then there's a fairly large portion already of existing centralized solar and hydropower. And this, in fact, is just, the top here is load, but it's net load. It's not accounting for all of the distributed solar that's also operating. It's about 21 megawatts in KIUC territory. So already you can sort of see the impact that all of this solar and hydro is having on the market. It's pushing down in the middle, and we are slightly underutilizing the baseload gas already today. A couple months ago, KIUC announced a contract with SolarCity for SolarCity to build a 13 megawatt solar project attached to a 13 megawatt, 52 megawatt hour lithium ion storage project. Now, why did they do that? Well, imagine first if KIUC had just contracted for 13 megawatts of solar alone. Here's how it might have looked on that same day, right? It generates right in that same middle period of the day when all the existing solar and hydro is generating. And ultimately what that does is it just pushes down in the middle of the day. That means you end up underutilizing the baseload plant even further. That's expensive. It's also not optimal from a greenhouse gas reduction standpoint. You end up generating more greenhouse gas from underutilizing that plant. It doesn't actually take away that much of the diesel, which is really what you want to be getting rid of. It just doesn't provide that much value, and it doesn't help you in that evening when you need it. So in reality, had it not been for the possibility of storage, I think you can pretty safely say KIUC wasn't going to contract for any more solar. So we would have hit the penetration limit in KIUC territory, or at least very close to it. Instead, they get this solar plus storage project, which ends up doing this. Basically what they're going to do is they're going to take all the solar generation in the middle of the day, they're going to charge the battery, and then they're going to shift it all out into the evening peak from about 5 p.m. to 10 p.m. and put all that generation there. Instead of stressing that baseload plant, it ends up generating right when you would have had the expensive peaking resources and a lot more diesel. So it's good from a greenhouse gas reduction standpoint, and it saves you a lot more money. This is why this is sort of a micro example of, I think, what's going to be a macro trend here, which is that as solar grows in penetration, you're going to see more places that start to look closer to Kauai. We're not going to get anywhere on the mainland that looks like Kauai tomorrow. But if you're treating Hawaii, as a lot of people like to call it, as a postcard from the future, this is a real factor. And at the end of the day, storage is probably the primary mechanism to mitigate the value deflation effect on its own. The other mechanism that's worth its own note is load control. Right? The other thing you can do, apart from just shifting solar generation, is you can shift load from, say, the evening when the peak is today, earlier into the day when solar is generating more. Rocky Mountain Institute's been doing some really great work on this, and they call it demand flexibility. Right? There's actually a huge opportunity to shift load. And if ultimately what you're trying to do is get more solar penetration that is more valuable, then demand flexibility is another major factor that it's another major lever you can turn. So it's important for the solar industry to pay serious attention to energy storage, even if you don't think you need to do it today, just because of the value it'll have in the long term. And then finally, I think it's important for the solar industry to recognize how transformative some of this market reinvention that we're starting to see in places like New York can be for distributed solar. New York is under the Reforming the Energy Vision initiative, it is trying to completely re-envision the way that electricity is delivered and the role that the customer plays. It introduces this whole new suite of companies in the mix. It turns utilities into distribution system platform providers who are there to basically make a market so that customers or third parties who are operating on behalf of customers can play in a variety of grid markets to provide a variety of different kinds of value. New York is clearly sort of the furthest ahead of this, and REV is something to talk about easily, but it's happening basically in California just through a variety of proceedings as opposed to just one. And ultimately, it's going to change the way that you get value for distributed solar. I think this world of we sell solar to a customer, the customer gets bill savings based purely on the rates and full retail net energy metering. 10 years from now, that's going to look unfamiliar to us. I think the way it's going to look then is you may still be able to offer customer savings, but you're also going to have the option to add on additional technologies to make their generation more controllable. You may be able to change their load as a result of all of those things. You may be able to be aggregated with a bunch of other homes or businesses or buildings that are bid into a market and get additional value. That may be revenue that is shared with the customer. It may be revenue that's just passed through to the customer in the form of a lower bill. I don't really know how it's going to play out, but I do know that these markets are actually changing in a meaningful fashion in a way that will impact solar, both in terms of the economics and also where it's deployed. At the end of the day, a lot of these things are about providing data to third parties so that they can make smarter decisions about where to site things like solar, where they will have the highest value to the grid and the highest value to the system. And so that's going to change the paradigm of how we acquire customers and find them and what we offer them. So it's important to pay attention to those markets because they will dictate the way in which solar is deployed over the longer term. So if I'm stepping back and I'm just thinking about what all this means for solar in the US, I guess lately I've been thinking about it in sort of three phases, right? There's the very near-term phase that is, say, today through the end of 2016. And it's going to be a bonanza, right? We already know that there's 13 gigawatts of solar that somehow has to come online next year, maybe even more. There's still new PPAs getting signed for 2016 right now, right? This is an enormous amount of solar we're going to be building out next year, completely unprecedented in this country's history. That's going to cause all sorts of problems, right? There may be a shortage of EPCs. There are people talking about an EPC bottleneck. There may be a run-up in prices for some components. There may be interconnection delays that could cause some projects not to qualify for the ITC where they would have otherwise. So we have 14 months ahead of us of just, utter craziness unless the ITC gets extended before then. Then, assuming again the ITC doesn't get extended, we have a weird period from 2017 to 2019 when we're going to be trying to figure out how to make this market work, potentially in the absence of a 30% ITC. There's going to be a heavy focus on cost reduction to make sure that the economics still pan out. And, the need for a lot of smart strategy to figure out exactly how to right-size your operation, how to right-size your business, and where to be playing strategically so that you can still get these projects done. And then you can look a little longer term, and the next phase, starts in 2020 and maybe goes for the next decade. And that's the one that gets really exciting to me, because all these things together will have sort of come to fruition or will be coming to fruition and will change the nature of the electricity market in a manner that, generally speaking, I think, will benefit solar and create a whole panoply of new opportunities for solar providers to introduce new technologies, new deployment mechanisms, new financing mechanisms to make that market work. So it's an exciting time both right today, and if we're thinking about the next order of magnitude for solar in the US. And I'm truly looking forward to hearing from all of you and learning from all of you over the next couple of days about how we're going to get there. And with that, I'm going to hand it over to Stephen Lacey, who's going to do our first fireside chat of the conference. Thank you very much. Oh, thank you. I appreciate it.